Ken, thank you so much for joining us on Closing Bell today. Let's kick off with a view on the Forex data that came through today for last week. We saw the Forex holdings of the government slipping back to 4.54 billion shillings, and that, of course, from 4.62 billion shillings in the previous week. This is a worrying sign, of course, because we know that the CBK is very adamant with regards to coming to the market and defending the shilling. So are you concerned right now about the ability and the firepower that the CBK has in its war chest?
In terms of firepower, I think the basic tool that CBK has for supporting the shilling is basically just controlling the amount of liquidity in the market. That's the repo and reverse repos. When it comes to direct intervention through sale or purchase of US dollars, CBK has tended to be quite weak. They've actually, the reason we've seen the Forex reserves come off slightly is because they've actually been coming into the market to sell off dollars in the past week. Although these were, the CBK never specifies the amounts they're coming. It's not public information. But they have been coming in, but the effect we've seen is negligible. Actually, what happens is it serves no purpose. It just drains our Forex reserves, our Forex cover, and has no effect on the market. They tried this before when we saw the shilling weaken to its lowest late last year. And going forward, yes, it is quite worrying, especially the weakness of the Kenya shilling is actually one of the vulnerabilities that may affect our inflation numbers.
What is the key factor? Is it the fact that we've had yields slipping below 10%? That, of course, the 91-day T-bill weighted average rate, it came in at 9.8% at the close of last week from above 10%. Or is it the fact that we've got a stronger dollar? Or is it a mixture of many factors right now that's playing into this weak shilling?
Actually, I think it's a mixture of quite a number of factors. Of course, the shilling does fundamentally have a few problems which have not been sorted out since the slide we saw last year. The only thing we've seen are temporary measures through tightening of the monetary policy. Our current account deficit still remains quite high. This hasn't changed much. What we've seen, the effects that the MPC actually hoped that would help come in and strengthen the shilling, probably long-term effects were, for example, contraction of credit expansion. This has been actually happening a bit slower than they expected. Imports are still quite high. Of course, there's some external factors such as oil prices, which we can't control. This has been rising steadily. But also globally, we are seeing a lot of investors running towards the safety of the dollar. So a stronger dollar, generally in a global sense, has also weakened the shilling. And as you mentioned, lower yields. We've seen a lot of foreigners who are quite active in the last 6 months on the local primary market in T-bills and short-end papers begin to exit the market and sell off holdings. So this has also really weakened the shilling. We actually expected this. I think we had mentioned it around the end of the first quarter, that come this second quarter and also in the third quarter, we'd see a lot of foreigners would come in to take advantage of the high yields we were seeing in the market, begin to exit the market, and this would affect our local currency. Yeah. So going forward, yes, there is quite a big threat to our shilling through external and also domestic factors.
But if you look at where yields are trading on the 91-day short-dated paper, and of course even the 30-year paper, you've got that sitting at 12.5%, and that T-bill, that short-dated paper sitting below 10%. That really an indication of what inflation expectations are right now, if that's anything to go by.
Yes, it's actually, it indicates where most of the market, the expectations are for the next 12 months. This is the first time, this week was actually the first time we've had an upward sloping curve, which I'd call probably a normalized curve in the last more than 12 months. Our curve has been inverted. So we expected this, and yes, most of the market does have positive outlook on the inflation numbers going forward. Although the threats do remain. But what we're actually seeing because of the volatility in the money market, we actually do see this. We are seeing this affecting the money market rates. For example, the interbank rate has risen all the way to 19% from around 16% at this time last week. Also, we're also seeing probably 1 month, 3 month, 6 month rates are still quite high. for 6 months, you'd get a money market rate of about between 15 and 16%. So there's a lot of uncertainty also when it comes to money market rates, but when it comes to fixed income instruments, I think the market does price in inflation more in fixed income instruments than on the money market.
Ken, thanks so much for joining us. Thanks for that update. Ken Minjire, fixed income and money markets analyst from Stanbic Investments.